Now, taking a look at the market right now, falling back for the third consecutive day, profit taking, in your view, is this what's driving the retreat?
Basically, yes. Like what we've been saying for quite some time is that the mini bull run that was there is a bull run that is in between a bearish period, which are normally called bull traps. And in this case, it was caused by the good, the better than expected results that were being announced and the higher dividends by some of the companies that were being announced. So everyone was trying to take a position. And those who had taken position earlier, most stocks have gone up by 20, 15% from announcement of results up to now. So most of those guys are now looking at the dividend yield and the capital gain that you've received. Most of these guys are actually now just taking their profits. And the ones that will suffer now are the ones that have come in now in place for the dividend. So now they'll get into the trap, because after the book's closure, I actually do not see much momentum pushing the market further upwards.
Now, looking at some of those results that were out, we had Access Kenya posting a pre-tax profit of 130.9 million shillings. The company's stock, however, is the second worst performing stock on the NSE, down about 26.2% this year. What are your thoughts on that company?
They did well to manage their cost. If you look at their results, actually, revenues only grew by 7%, which is quite a bit dismal in the type of market that we're in. And those revenues will continue suffering because now the telecoms, who already have the clients in their hands, have been now going aggressively and also reducing their data prices. So in terms of pricing for Access Kenya, they're a bit in a fix because they don't have much flexibility on their pricing, because they're now competing with 4 telecom companies that are offering the same services that they're offering, not only to retail, but also to the corporates. And it's easier to pick a call from Airtel or from Safaricom and they tell you about their products than someone from Access Kenya who you're not a client to call you. So they have that problem even in their marketing going forward. So revenues will continue suffering. The best thing they can actually do is just maintain their cost and try to cut their cost and be innovative going forward.
Now, looking at the company, we're seeing that competition within the data space in Kenya is quite stiff. Now, there was talk last year of Access Kenya that it could be a takeover target due to its extensive fiber infrastructure. What are your thoughts on that? Still a takeover target?
It really depends, because if someone is not going to see value going forward, like what we say, the competition around them is so much, and the barriers to entry in the industry are slowly reducing as CCK keeps on licensing people and also having joint ventures with the players in the market. So going forward for them, as much as they have a robust fiber infrastructure, they don't have the best. You find companies like Jamii Telecom, companies like Zuku, companies even like Safaricom and the telecoms have more robust fiber infrastructure that is around and a lot of redundancy that they have. So it's really tight competition, throat cutting actually. So it's going to be a tough year even for them this year.
Looking at Nation Media, also out with results, posting a 31% growth in full-year pre-tax profit, but that stock not responding to those positive results, down 3% on the day. What did you make of those numbers?
The numbers are good. We're in an election year, and there's a lot of money sitting idle just waiting for advertising. And them being one of the biggest media houses in terms of viewership will most probably eat the greatest part of that pie from either the Electoral Commission of Kenya as they try to do civic education, as political aspirants, presidential aspirants also try to make themselves known. So going forward for them, they actually look like they have a very good year coming in for them. So investors are actually not pricing that in. But I think maybe the problem that might also be coming in, if you look at their cash flow drastically dropped by close to 80%. And we still need to look for the explanation why their cash flow, cash added last year was lower than the rest of the years, which might be now putting investors slightly at bay, trying to see whether are they going to get cash strapped, are they going to need to borrow, are they going to have to go on an overdraft and issues like that.
Now, I know you're not a big fan of the banking stocks, but let's look at Standard Chartered Bank. It came out with results yesterday reporting a 7% increase in pre-tax profit. That stock falling back in the session. What did you make of those numbers?
below average in terms of if you look at the competitors, the results that they've been announcing during this announcement season. But as much as I don't like banking stocks, Standard Chartered is actually kind of a bit of a darling or a favorite to me because they are robust. Their business model and strategy is actually robust. Thank God to the years that they nearly collapsed and they were bailed out by African central banks, which taught them a lot of lessons into how to manage their assets and their liabilities. Because if you actually look at the return of equity for Standard Chartered Bank, it's actually higher than KCB and Equity, who are announcing astronomical high results. But as an investor, it's what am I getting for the equity I've put in this company? And Standard Chartered actually year on year been able to provide higher return on equity than the rest of these guys. So yes, the growth might be small, 7% growth in interest income, but at the end of the day, are they still paying me back more as an investor? And that's what matters for me when it comes to Standard Chartered.